Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, October the 9th. I'm Jay Gragnani.
And I'm Ben Jones.
And October is here.
It is.
The fall weather is upon us here. I don't know what happened. I left Monday, went to New York in short sleeves, woke up Tuesday morning, and it was 60 degrees in New York. So the fall, and I got back home and long sleeves and long pants are still back out.
I mean, jeans yesterday. I mean, it's the first time for me. I'm not wearing jeans, of course, but it's interesting. It's like fall is here, and all of a sudden, have you overseeded yet? Have you started planting grass, work on the yard?
Yeah, now is the time to be repairing the yard. Not unlike repairing your portfolio. You look in today's market in October. October is one of those months that on the averages, doesn't average down.
Right.
As a matter of fact, it produces, if you go back like to 1950, it produces positive returns on average. But October is just one of those months that we've seen historically a lot of volatility in the month of October. Some of the major market crashes, October of 87, 2008 you had a very rough time. Right. 29 you had 29 was Black Tuesday, 87 was Black Monday. Yeah. 08, and then last year wasn't easy, but really you go back to 1950, and 2018. So last year was only the fifth time that the market in the month of October was down 5%. Only the fifth time. And only one other time has that actually happened in consecutive years. That was 78, 79. Okay. And so, it's one of those environments that certainly breeds a lot of volatility. Historically, coming off of September, which September is the worst performing month. And then October is the month that also ends the seasonally weak period in the market. And so that period from May through the end of October. And it's interesting this year, if you look to see, well, hey, what has the market done during the seasonally weak period this year? And the answer is it's done a whole lot without doing anything.
Right.
And, it's been a roller coaster. You look at, returns for the S&P January through the end of April, and it's about 17.5% for the S&P 500. And since then, we're down about 1% since the beginning of May. But during that time, you've seen 5 different moves of 5% or more. And that's the volatility that a lot of investors are feeling of literally every single month since May, we've seen a move either up or down 5% in the market. And here we are in the month of October. And, we've seen a 5% pullback off of the October high.
Yeah, and as a result of that...
the September high, sorry.
And as a result of that pullback and the volatility that we've seen, it's just evidence of selling pressure that we've seen across the market. And just last week on October 3rd, we saw the New York Stock Exchange bullish percent reverse down in O's, moving from basically 50%, so that halfway line, down to 44%. This was basically a result of more stocks on the New York Stock Exchange moving to sell signals on their point and figure chart. As a result of this move, Jay, basically it moves the indicator into a more defensive posture. Yeah. And when you really look at kind of what is giving sell signals, what is causing this indicator to reverse down, it's, if you think about the New York Stock Exchange and you break it down by size, roughly 44% of that universe that we track is small cap. And when you look at kind of the areas that are giving off sell signals or what areas are on sell signals, it's predominantly small cap. Roughly, 65% of small value is on a sell signal, 59% of small blend, 65% of small growth are on sell signals within that universe that we're tracking for this bullish percent. If you look at the large cap side, only 46, so less than half of large value and 49% of large growth are on sell signals. So there's a big difference between small and large cap right now. And so, for those, seasoned veterans tracking the bullish percent, they like to use the old saying, when the soldiers are leaving the battlefield, the generals will soon follow, or something along those lines. And we have seen the soldiers leave, right? Yeah. It's been kind of 2019 in a nutshell, yet the market moves to new highs. Why? Large cap remains a strong size group, and large growth has been a leading size and style group. What's interesting is that, don't want to draw any parallels to 2018, but it does show you that October, for whatever reason, from a psychological standpoint, some would argue it's linked back to the old agrarian cycles of the weak seasons, strong seasons. We saw the bullish percent reverse down in October last year after kind of forming a top, and we've seen that happen this year again. So we definitely want to, monitor positions. We have a playbook that you can follow. We published a playbook in our daily equity report the other day. We are in defense in the middle field. It's a great time to look at substituting ETFs for individual stocks. Kind of reduce your individual stock risk is one suggestion. Tighten up stop losses. So for those subscribers, you can look at that report or go to the prospecting page and look at our BP playbook. But for what it's worth, small cap is the primary driver, Jay.
Yeah, and I was just pulling up and looking at a chart of like IJR, which is the iShares S&P 600 small cap index. So it's a basket of 600 securities that are defined as being small caps. And while we sat here watched the market as defined by the S&P 500, which as you mentioned, it is the generals that carry the weight of that index, and so they're just a massive mega cap type of stocks. That index, the market, the S&P, moved to new highs earlier this year. The SML, the small cap stocks, they weren't even able to come close to their highs from last year. And, that is certainly a sign of small caps negatively diverging from the market. And then you look at, the S&P 500 is off about 5% currently from its highs. Okay. Small caps are down almost 17% from their highs. And so, to your point, absolutely, the small caps have been the group that has bared the brunt of a lot of the deterioration from things like the bullish percent, but also other areas of the market as well. In terms of speaking of the generals, it was interesting because technology as a group, as a sector, this whole idea of growth versus value, and that's kind of an interesting dynamic. But from a sector perspective, technology is the one that continues to carry the baton in a lot of the cases in terms of just year-to-date performance. You look at like XLK, which is the technology select sector spider, up 27% this year. The equal-weighted version of that, though, is up 22%. Okay. And so the cap-weighted version, the generals that are overweighted in that cap-weighted, namely stocks like Apple and Microsoft, the two biggest names, which account for a bulk of the return, they're up 42 and 33% respectively so far this year. So those names certainly are holding up very, very well. The big cap stuff, the large cap growth in general is the style box that continues to carry the baton there.
Yeah, and we see that in a lot of our relative strength rankings, right? If you look at Dolly, technology is the leading group. If you look at the size and style, large growth, mid growth are the leading style boxes. If you look at our group scores, right? Every single mutual fund and ETF on our system is scored. It goes from 0 to 6, 6 being the strongest. Large growth, that's an average score of 4.24. Right? Again, if you want to look at the difference between small cap and large cap, the average small cap growth fund has a score of 3.32. I mean, almost a 1 point gap in score. And that goes across the board for all the different styles, right? I mean, large value, 3.56, small value, 2.06, right? And so you see that really across the board. And so for what it's worth, continue to overweight those areas that are working, and that's large growth. Those are some of those sectors you mentioned, like technology, that are strong. We still see some strength within some interest rate sensitive areas. Some might argue value areas. I mean, really just tied to interest rates right now. There's demand flowing. Prices are pushing higher relative to other sectors in utilities and real estate, right? We saw real estate move up to top 4 in one of our rankings. Yep. So we continue to see momentum exhibited in that sector. You mentioned the S&P 500. The SPDR S&P 500 ETF Trust, Jay, the SPY, it's testing an interesting support level there at 285. If it does break down, could set up a shakeout pattern, right? Which is actually a bullish pattern, and that might be a bullish sign for equities if we see a breakdown, setting up that shakeout, and the action point would be on a reversal up. So that's an interesting pattern that we've seen develop as the market, TCA, has kind of been choppy up and down, that 5%. We hit resistance, we came back down, hit resistance again, came back down, now setting up for a potential shakeout if it breaks down. So, that's one interesting kind of really purely technical development we're seeing on that chart. Another thing to mention, We had all our analysts together in the meeting this morning. We're talking about these trends. We talked about international. The U.S. dollar continues to push higher, or higher rather. And we see the U.S. dollar scoring at 3.57 using the UUP, Invesco Bullish Dollar Index Fund. We've seen a really strong move off of a kind of a score low, moved about 1 point off that low. And we've seen this has a negative impact for international equities. And if you look at the S&P 500, scoring at 3.09, EFA, developed markets, and EEM, emerging markets, are scoring at, let's say, 2.01 and 0.65 respectively. So EEM is scoring at 0.65, EFA scoring at 2.01. So not only is there a big difference between large cap and small cap in the U.S., there's a big difference between leadership globally, right?
Yeah.
The U.S. is still stronger than some of those other products out there.
Yeah, and I mean, obviously, everything going on in China,
Right.
Hong Kong, lots of volatility, lots of downside pressure on the equity markets there. China is, the largest holding in those broad-based emerging market ETFs like EEM, VWO, those types of big names. So that's, China certainly weighing pretty heavily on that. And it's also interesting that, looking at something like EFA, whereas the S&P 500 is testing support and initially has held that bullish support line, so that positive trend line. On the flip side of that, EFA, or developed ex-US markets, are testing and failed at resistance to resume their downtrend. So there very much is a pretty big difference there between the leadership trends of US equity and the global equity market. Yeah,
and you mentioned China, of course, in the headlines. I mean, anything trade related, anything Hong Kong related. We have seen some rotation in some of our international ETF models. China recently rotated out of our Franklin Liberty Shares International model. We see it added actually France. So we're beginning to see it pick up some more developed market exposure. So what's interesting about that is we're now seeing it was about 80% emerging. Now it's only 60%. And so we are seeing those trends play out in some of these rotation-based models that a lot of advisors use to enhance or complement kind of their existing, let's say, core international products that may be like an EEM or EFA or something like that.
Yeah. Certainly, no lack of activity in the market.
Right.
Lots of volatility. With long-term trends being positive, but indicators like the bullish percent being negative, would not be too surprising to see volatility continue as we head through the month of October. Then look forward to turning the calendar to November, which starts the seasonally strong period.
That's right.
Obviously, the market doesn't necessarily always care and doesn't necessarily turn on that day, but just there is a massive seasonal bias towards the market where November starts a very strong period historically in the market. But for now, we'll play the cards that we are dealt and continue to move forward through the month of October from here.
Absolutely. And just before we end, just a few housekeeping items. We have our Point and Figure Institute coming up in the fall.
Right, yeah.
In November. Registration is still open, so definitely sign up if you can. For those of you who have access to the Daily Equity Report, you can see a registration link. It's a great event. We'll have generally about 100 advisors show up. You'll go from all the way from the basics of point and figure methodology all the way up to the more advanced kind of portfolio management topics. And then next week, we have a webinar on October 15th. That's a Tuesday. That's actually, we are involved in a webinar with the National Association of Active Investment Managers, NAME for short. That's going to be with pro funds, right? So we're going to be talking about, leverage funds, leverage sector funds, and some different concepts that we've been exploring from a research standpoint. So definitely attend that if you can. So that's with NAME. It's titled A New Approach to Relative Strength Investing with Leverage Funds. Again, October 15th, 4:15 to 5:15 p.m. Eastern Time. So check that out as well. Registration link is in the Daily Equity Report.
That sounds great.
Yeah. All right.
Well, as always, we appreciate you joining us this week and look forward to be back on with you next week.